everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chan, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google Map for hardworking Canadians seeking financial freedom. And today's topic is seller financing, or sometimes people refer to it as vendor take-back mortgage. Why are we talking about seller financing or vendor take-back mortgage? Well, the reality is that a lot of clients these days are looking to sell, and sometimes the buyers are taking advantage of the current situation or the seller's motivation to sell, and they put forth something called seller financing, asking the seller to finance their purchase for them. As a matter of fact, we see an increased negotiated deal based on seller financing being completed, and that's why I figure it would be relevant for a lot of real estate investors out there to get to know what seller financing is. Now, but before I get started, make sure you give us a thumbs up if you like our video, or hit the subscribe button below so then you can stay on top of the latest tax tips. Now, with that, let's get started. Okay, first, we need to explain what seller financing or vendor take-back mortgage means. I typed that into ChatGPT, my best friend right now, and it comes up with an excellent example to explain. Toy. Imagine you're trying to buy a toy and you don't have enough money right now. Instead of not having the toy immediately, or going to the bank or going to your parents to ask them for money, your friend who is selling you the toy says, do not worry, you can pay me back over a period of time, you can have my toy right now. So this is how vendor financing essentially works. You own the toy, but you are paying your friend over a period of time, until which point you fully pay off the entire amount that you owe to him, and then you own your toy right out. In real estate terms, sometimes the seller would offer the same thing to the buyer. With vendor take-back mortgage, the seller is essentially playing the role of a bank. Sometimes, depending on your negotiation and the deal, the seller would demand an interest, or the buyer would offer an interest on the loan that's payable to the seller. And the interest payment term, depending again on the deal, could range anywhere from like immediate interest payment to end of the year interest payment or monthly interest payment. And the repayment term could also be in combination with the principal repayment as well. So it really goes back to the negotiation that is agreeable between the buyer and the seller. Every single deal is different. As I mentioned before, seller financing could also be used in combination with bank mortgage. So typically what I see in the marketplace is that the bank mortgage would be registered against the property in the first position. In case the buyer default on repayment of the mortgage, the bank would be in the first position to collect their debt before the seller financing would kick in. And typically seller financing is registered as in second position. Now, what are some other benefits for people to offer seller financing? As I mentioned before, the seller would be able to earn interest income on the amounts that they loan to the buyer to close the deal. And other additional benefit is the capital gain deferral. A seller who offers seller financing or vendor take-back mortgage would be eligible to claim something called capital gain reserve. You would be able to spread, as a seller, if you offer that type of arrangement, you could potentially spread out your capital gain over a number of years, up to a maximum of 5 years in total, to pay your taxes, to include a capital gain you realize on your personal tax return or corporation tax return, for that matter. And this gives you the flexibility of deferring some of the taxes that you would otherwise have to pay. Now, is it beneficial? Would that help you save taxes? Now, that really goes back to our calculation. And now I'm going to show you exactly how you would calculate and how capital gain deferral works. So now you might wonder, how do you actually calculate the capital gain and also the capital gain deferral that you're allowed to take, and eventually, ultimately calculate the amount of tax payable and see if you have any tax saving? You need to follow this two-step process. The first step is you must calculate the capital gain. To calculate capital gain, you need to take the sales proceed minus all the expenses, and then subtract all the improvement that you've made to the property over the years that you recorded it as part of your capital improvement. Also, your purchase price of the property and closing costs of your purchase. The net amount of that would be considered your net profit, which typically is considered capital gain. If you want detail of how you calculate the capital gain of a particular property, property, we have a video above that you could use and refer to help you to come up with the calculation of your capital gain and the tax payable on that capital gain. Now, the second step is to calculate the capital gain reserve. And we're going to use an example to show you exactly how the capital gain reserve you would use to calculate. And realistically, the third step is subtract and do some maneuvering to understand and how much capital gain you would have to report on an annual basis and how much you would be able to defer. Capital gain reserve equals the amount of deferral that you're allowed, not including in current year's income. So with that, let's use an example to explain. Now let's use a real life example to explain to you how this would work. Recently, my client got an offer to their commercial property, and the buyer are asking for 80% financing. So in our example, using 80% financing, the buyer is asking the seller to agree to lend them $592,000. And using $592,000, this amount matters. The buyer is asking the seller to finance $592,000, and they're willing to pay 20% of $740,000 as the down payment. Now, that amount is about $148,000. So they're only willing to pay $148,000, and they're asking my seller, my client, to essentially finance the rest, $592,000. And the term is interest only, so there is no principal repayment over the next 5 years. And my client would be offered 6% interest on the vendor take-back mortgage amount. So that's essentially the whole scenario. Now, for them, what's the impact for my client in particular in this particular situation? This is important to go back to the actual definition of how to calculate the capital gain reserve. Now, we need to come back and go back to calculate based on the CRA formula, how to come up with the capital gain reserve on an annual basis. So then we know the amount that could be deferred on an annual basis. Now, so then to back up a little bit, to calculate the capital gain that you are required, the seller is required to report on an annual basis. You need to come up with the total capital gain, subtract the total capital gain reported in prior years related to the sale of this particular property, and also subtract the capital gain reserve allowed. Now, how do you come up with the capital gain reserve? Well, the capital gain reserve, as a matter of fact, follows this formula. Capital gain reserve equals the lesser of proceeds that you have not received divided by the total proceeds times the capital gain. Or 100% of the gain multiplied by the percentage indicated below based on the year of disposition or year after the disposition. If it is first year, then it's 80%. If the first year after disposition, it would be 60%. Year number 2 is 40%, and third year would be 20%, and the fourth year would be 0. Sounds really complicated, and I agree it is complicated. Let's see how this formula, how we apply this formula to our client's specific situation. Now, as mentioned before, the client was offered $592,000. There's no repayment term and interest only every year. The buyer will deliver the interest amount to my client's account, and so we need to come up with the tax implication. Now, looking back at the calculation, we need to know the tax implication and the actual cash amount outlay that they need to pay. So if you are looking at the formula, we need to first calculate the capital gain. And we concluded that from previous calculation that the capital gain is about $100,000. Now, then we need to come back to calculate the capital gain reserve. Now, the capital gain reserve is lesser of the proceeds that you have not received divided by the proceeds of disposition multiplied by the capital gain. So that is column 1 here. Now, it is really simple because if you think about it, the proceeds that you have not yet received would always be the same because the amount of $592,000, the vendor take-back mortgage amount, is not paid back until the end of 5th year. So the amount would always be $592,000. So proceeds not yet received would be $592,000 divided by the proceeds of disposition, which would be $740,000. Multiplied by the amount of capital gain, and in our example, it's $100,000. So the formula under column 1 would always be equal to $80,000 every single year. Now, number 2, which is part of the formula, is that you have to come up with the 100% of gain multiplied by the percentage indicated on this table in as per CRA. So this table for the year of disposition, the amount is 80%. So 100% of the gain, which is $100,000 times 80%, then that means the year 1 is $80,000. 100% of the gain in year 2 times 60% in year 1 after disposition is 60%. If I take $100,000 times 60%, it equals $60,000, and so on and so forth. So by the end of the 4th year, if I take $100,000 multiplied by 0%, the amount would be $0. So this is how to come up with point number 2 under column 2 for every single year. Now the amount of capital gain reserve is the lesser of 1 or 2. So we go back and look at which one is the smaller amount, and then we choose the smaller amount. So year 1, the smaller amount, essentially they're the same, so the reserve would be $80,000. And the capital gain reported would be equals to the total capital gain amount minus the reserve minus all the gain reported in prior year related to this particular sale of the property. So capital gain reported is equals to total capital gain. So total capital gain in this situation is $100,000. Now minus the reserve amount is $80,000. So 100 minus $80,000 is $20,000. And the gain reported in prior year is 0 because this is year 0 and it is the year of sale. So in year 1, this particular seller would need to report $20,000 of capital gain. In year 2, we do the same calculation again. The total capital gain is $100,000 minus the reserve, and the reserve is calculated to be $60,000 in year 1, end of year 1. So 100 minus 60 would have been $40,000. Now $40,000 also minus the gain reported would be minus the $20,000, so less that, it would be $20,000. Basically, you follow the amount, follow this formula, and then you would know the actual amount that you are required to report on your return on an annual basis based on this particular deal. As you can see, it's not really that easy. Now, this is the capital gain amount, but we all know that capital gains advantage, earning capital gains advantage, is the 50% taxable. Only 50% of the capital gain would be included as your income, and therefore only 50% of the capital gain required to be reported would be included as income. So only 50% of this column would be included. And will be taxable. So you're reporting about $10,000 of taxable income in year 1. Now, remember, we mentioned that the buyer is offering the seller a 6% interest rate. And based on the loan outstanding, the 6% on $592,000 is about $35,000 annually, $36,000. Now, the total amount of taxable income would have been $46,000. The combine of these two numbers, 10 plus the 35,000, so the taxable income would be $45,000. And the expected immediate tax balance would be $22,760. Now, I have assumed that the property is owned in the corporation because my client in our particular example would have been owning this property in a corporation. If you own the property in your personal name, your tax balance could be very different. Right now, I'm using 50% as my tax payable calculation. And also remember, a word of caution, the tax amount, 50%, the tax rate, 30% would be refundable when you declare a taxable dividend to shareholders. So it gets a little bit more complicated. You may not pay $22,000. At the end, you may pay way less than $22,000, depending on your particular situation and how you arrange the dividend payment as well. So basically, your $100,000 capital gain is being spread out over 5 years to be paid for, which is awesome. And you're paying the amount on an annual basis on a different tax payable. You're spreading out the tax to five years, and you get 5 years of essentially tax payable. But is it really good? Because remember, at the end of the day, in our scenario, you still owe the bank $300,000, but you're really only getting $148,000 from the buyer. You're not getting more than $148,000. You're financing the $592,000, but you're only getting $148,000. You sold your property for $740,000, and you are only getting $148,000. From a cash flow implication perspective, you're collecting interest income of $35,520. You're getting $148,000 of 20% of that down payment, but you have to pay out the mortgage of $300,000. You also need to pay the closing costs. Remember, the closing cost is the realtor commission and legal fees on closing. These two add up to be $40,000. And if you do that, and then you also need to pay the tax, $23,000. And at the end of the day, ultimately, you are net about negative $180,000 roughly. So you, at closing, by agreeing to finance 80% loan to value for your buyer to close this property, you have to come up with $180,000 to close the deal, to have enough fund in the pot to fully pay off your mortgage of $300,000 and also the closing cost of $40,000. So really sucks. I advise my client do not go as far as 80% because it means that you have to come up with an additional $180,000, which for majority of our investor client right now, they're looking for cash flow, not looking to sell and create a bigger cash flow problem. Now, let's look at the scenario slightly differently. Let's look at my scenario when the vendor take-back mortgage is only 40%. Look at how it is different from the example of taking a vendor take-back mortgage of 40%. Now, let's assume that they negotiated and they finally agree that the vendor take-back mortgage would be $296,000, only 40% loan to value. So immediately, our client is going to get $444,000 instead of only $148,000 in the previous situation. Now, that $444,000 is more than enough to cover the $300,000 mortgage outstanding. And so that's an awesome thing. But this $296,000 amount, the reduction in vendor take-back mortgage, would also have an implication on how the capital gain is being reported and calculated on an annual basis. So we use the same formula, calculated the same thing, and calculated capital gain reserve. As you can see, the capital gain that are being reported on an annual basis is now distributed very differently. In year one, this particular seller would have to report $60,000 of capital gain, and nothing in year one and year two. And at the end of year three, she finally would have to report $20,000 of capital gain, and year four, another $20,000 of capital gain. So based on the formula, the calculation would have a very different result. And the terms, as you can see, just by reducing the amount of vendor take-back mortgage, your capital gain reported on an annual basis could be drastically different from the previous version. So these terms matters. And if you have a repayment on an annual basis, this would also drive column number one differently, and therefore you might also have a different calculation on capital gain reported amount. Now, in this particular example, the capital gain reported is $60,000, $20,000, $20,000, as we discussed before, and 50% of that is taxable. And together with the interest income still at 6%, the interest income would be less because the loan amount is less. The interest income, taxable income is now different on an annual basis, and expected immediate tax balance would have been $23,000 for first year, about $9,000 every single year after, and then year three would be $14,000, and year four would be the same. Now, what does that really mean from a cash flow perspective? Now, from a cash flow perspective, you collect the interest income, the seller collect the interest income, and then immediately at closing, the buyer has to come up with $444,000. The $740,000 minus the $296,000. So this is about 60% loan to value. Immediately, the cash received by the seller would have been $444,000. Now, at closing, the seller would still be required to pay off the entire mortgage amount at $300,000 and also the closing costs, similar to what we went through in the previous scenario. And now the tax payable for year one would have been $24,000. Now, in year one, after collecting the interest income, cash received at the time of closing, paying off the mortgage, paying off the closing costs, and paying all the taxes, this particular seller, is going to get about $98,000 in total positive cash flow. So you're no longer coming up with a negative cash flow situation. You don't have to pay another $200,000 out just to close the property. So again, the cash flow situation, cash flow implication could be substantial depending on your particular situation. Now, every single year, you're going to collect some interest income. You're going to report some amount, and sometimes you may have a high interest income. Sometimes you may have a higher tax balance. Sometimes you have a lower tax balance depending on the amount of capital gain inclusion you would have to report. But by the end of the fourth year, everything would have been paid for. Now all the seller would need to do is to collect the final balance of $296,000 from the buyer. And that basically concludes a different scenario that you would be exposed. And obviously there are different type of scenario. It may not be 6%, so then the calculation would be different. It may be 3%, it may be 0%, or there may be repayment. This $296,000 that we're looking at, it could be repaid over the next 4 years, 5 years, so then the calculation would have been different. All these factors drive the calculation of the amount of capital gain that you would be reported, and also drive the cash flow that you would be essentially netting at the end of the day. Now, you may wonder, hey, Cherry, is there any benefit of doing this? Because it seems like no matter what, you're paying 50% interest rate. There is no particular reason why you should set up, why you would offer a seller financing, given the amount of complexity and also the high tax rate. Because it seems like if you report everything in year one, you're paying 50%, and if you report everything over a number of years, you're still paying 50% tax rate. Well, the reality is, in a corporation setting, because the tax on capital gain is always the same, 50%, the 30% of it would be refundable, and then the actual amount that you would pay over the long run is really 20%. But immediate tax implication is that 50% that you have to pay. Now, if that 50% is paid, it is the same whether you get that, you offer seller financing or not, whether you have capital gain deferral or not. It is always that amount, the number is always the same. So there is technically, it's no difference if you own everything in your corporation. So if you own your property in your corporation, it's less motivated, less beneficial for you to really offer that seller financing. Now, there could be substantial tax saving if you own the property in your personal name though. Now, let's go through that calculation together. So backtrack a little bit. The Canadian personal tax system operates on a progressive tax system. So the way it works is essentially the more money that you make, the more tax that you would have to pay. Now, if you look at on screen, let me quickly explain what that means to you. Now, let's say you earn $60,000 base salary. Now, if you earn $60,000 base salary, you're being taxed based on the tax bracket. So the tax bracket, the federal government has their own tax bracket, and then the provincial government also has their own tax bracket. Every province has a slight different tax bracket, but what you're seeing in front of you is an Ontario tax bracket. So between $0 to $12,000, you pay no tax at all. No Ontario tax, no federal tax. Between about $11,865 and $15,000, you're starting to pay a little bit of Ontario tax of 5%. Between $15,000 to $49,000, you pay 20%. Now, what it really means is that the delta between $15,000 and $49,000 of $34,000, that difference of the tax bracket, that delta of $34,000 is subject to 20% tax rate, and that is equivalent to $6,863. Now, for someone who's earning $60,000, a portion of that $60,000 income is going to subject to 24% tax rate, and then another portion of it, anything above and beyond that $53,000, is going to subject to about 29% tax rate. So all these add up to be about $9,988. So that is the actual amount that you would be owing if you earn a $60,000 salary. Okay, so now let's say you sold this particular property and resulted in $100,000 of capital gain. And we all know that only $50K would be taxable. So as a result, adding that $50K to your $60K of base salary, if you don't have seller financing, you are now reporting $110,000 of income, being $60,000 of your base salary plus the taxable capital gain of $50,000. Now, with $100,000, you are liable to pay about $26,000 of tax. Now, if you don't have the additional $50,000, you pay about $10,000 of tax. Now, at $110,000, you're paying $26,000 of tax. So an increase of roughly about $16,000. Now, let's assume that we now spread out we offer seller financing. And every single year, we have seller financing. And every single year, you're reporting only $10,000 of income more. So under the vendor take-back mortgage scenario with 80% deferral, you would be able to spread out your capital gain equally over the 5 years period. So each year, you'll be reporting an additional of $10,000. So $60K of salary plus and $10K of capital gain, taxable capital gain reported. This resulted to $70,000 of taxable income. Now, at $70,000, you are liable to pay about $13,000 of tax. So $13,000 of tax on an annual basis for essentially 5 years. Now, obviously, the first $10,000 has nothing to do with your capital gain. So only the next $3,000 is the tax implication of your capital gain. So about $2,953 is about $3,000 essentially. That's related to the tax payable on the $10,000 additional taxable capital gain that you're reporting. But you're reporting it over 5 years. So $3,000 multiplied by 5 years. So the total amount that you would need to pay on the taxable capital gain of the $50,000 would have been $15,000 over the years. Now remember, if you have $110,000 reported directly in year 1, there is no seller financing whatsoever, you would have resulted in $110K of income immediately. So remember, if you report $110,000, no seller financing, you would have incurred $26,000 of tax payable, and $10,000 belong to the first $60,000 of salary. So essentially, without seller financing, you pay about $16,000 of taxes. And with seller financing, you total only pay $15,000 of financing. So there is tax benefit. Although it doesn't look very substantial in our example, but there is definitely tax saving by offering some sort of seller financing. But the actual amount of tax saving, or if there is any tax saving, it would really come down to the terms of your seller financing situation, the terms, the repayment terms, and also the interest rate as well. And then reality is, at the end of the day, you also have to take care of your own cash flow. So let's not forget about the cash flow consideration as well. So now that we've covered everything from A to Z on seller financing, I hope you get a better understanding and better grasp at negotiation. If you're on the seller side, you know how you would be able to understand this a little bit better. If you are on the buyer side, you may also want to use this video to offer seller financing. Include seller financing in your particular offer. This may help you get a better deal, especially get the property closed. If you like our video or find the video useful, please give us a thumbs up and share that with your real estate friends. Until next time, happy Canadian real estate investing.